Hello everyone. Let me begin with the monetary policy decision which was announced on 2nd June 2015, where the RBI delivered a 25 basis rate cut, taking the repo rate from 7.5% to 7.25%. This was largely in line with our expectations, as also most of the people in the market were expecting a similar outcome. The critical thing in the policy was to decipher what the future guidance was from the RBI governor, and that seems categorical at this point in time that incremental rate cuts, if any, from now would be contingent on how the monsoons in India pan out, as also from a global perspective, how soon or how much will the US Federal Reserve hike rates. That was clearly evident in yesterday's market movement, where despite a 25 basis rate cut, we actually saw the government bond yield curve sell off, and the 10-year benchmark is close to trading at about 7.75%, almost 10 basis points higher before the policy decision. We do not perceive the monetary policy to be extremely hawkish, as also extremely dovish. I think it's very critical for us to understand that RBI is very keen to ensure that the path of disinflation is not disturbed at any cost. So therefore, it is imperative for us to understand the central banker decision in that light. We believe that there could be some range-driven movement in the market, but it is not likely to move into either extremes. What should investors do in such a market scenario? As I mentioned, since we are expecting an extended pause from the Reserve Bank, and the pause is to be viewed in the light of developing monsoon conditions as also global economic situation, we believe that both these data points we would have reasonable clarity towards the end of this year, probably therefore making a case for one more rate cut of 25 basis points in the first quarter of 2016, which is the Jan to March quarter. What should be investors' investment outlook in such a market scenario? Well, our stance is very clear. Those investors who came into the duration strategy should continue to stay put. We believe that this has not derailed the rate easing process, but probably delayed it a little bit. We've always maintained in past occasions as well that India is seeing a disinflationary scenario in line with most of its global counterparts. Therefore, it is inevitable that we see lower interest rates over a period of time. So patience is going to be very, very relevant for duration investors. For those who want to ride out this volatility or weed out this volatility, we would actively recommend looking at accrual funds like Kotak Income Opportunities and Kotak Medium Term. The advantage of these kind of funds are they have an inherently higher yield to maturity or YTM, which is a tad higher compared to the standard short-term funds. Of course, these funds do take a little bit higher credit risk, but we believe we have robust processes in place which allows for us to take these kind of risk, especially in a market or in a scenario, in India especially, which is poised on the growth path. For those investors who are looking at investment alternatives less than 1 year, probably the ultra short-term funds like the Kotak Treasury Advantage Fund and Kotak Equity Arbitrage for a liquid equivalent risk is something which we would clearly recommend. To conclude, we believe that the interest rate cycle of easing has not completely ended. Probably a pause is inevitable given the current macroeconomic scenario, both domestically as well as globally. But so long as the eyes on inflation, as far as we are concerned, or as far as a central banker is concerned, who is doing the inflation targeting job, as far as that is on track, I don't think we have any reasons to worry. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.